So we went through the income tax formula. Now let's figure out the steps to calculate your taxes, right? Let me take a water sip first, sorry. All right, end of the year. Now what? First thing you want to do, gather all your necessary tax documents. Some common tax documents include the form W-2, which is what you get from your employer. You will also get 1099s. Some common ones include 1099 INT, which stands for interest. If you have any interest from your banks or investments, you would get this. 1099 div is short for dividends. If you have investments that give dividends, you're going to get this as well. 1099G stands for government, G for government. So if you get any payments from the government, this includes unemployment benefits, you would get this. 1099 miscellaneous is for any other income that you made. Whoever received the money should be giving you this. And lastly, there's also if you're currently going to school, you will get a form 1098T from your university or qualified institution. And this is necessary for claiming certain education credits. And all these documents typically are supposed to be given to you by February. By law, that's their deadline. So what happens is they give a copy to the IRS and they give you a copy as well. So that's how the government cross-checks whether you are not reporting the correct amount of income. And this is how high level of how they do audits, right? They compare the documents they receive from the payer and compare the tax return they received from the receiver, and they would see if that adds up correctly. So these are common tax forms. Let's go through what the form W-2 is. Its long name is wage and tax statement. And at the end of the year, your employer is supposed to give this to you. It includes your total gross pay, so before taxes and other deductions for federal and state. It also includes the total amount of FICA deductions. Remember, that's Medicare and Social Security, and other miscellaneous information that you'd need for tax purposes. This is what the W-2 looks like for 2021, even though you probably won't get one yet. So in box 1, that's your total wages and tips and other compensation before taxes. And then box 2 is how much federal taxes they took from that. Box 4 is Social Security tax they took. 6, Medicare tax that they took. State is always at the bottom. So 16 would be your income for the state. So sometimes people work in like different states and you might have different states here, right? So what's considered you earned in California versus, let's say you work in New York part-time as well, then New York would be like down there or something like that. So that's why there's a split between state and federal, and also Social Security and Medicare for various reasons. 17 is how much state income tax they took out of your paycheck. The California disability insurance deductions, they would be here under 14 other. And in box 13, this is actually where they would check if you qualify for these things. So if you have a covered employee plan for retirement, this box would be checked. So if your employer offers like a 401k or something like that, this box would be checked. And for anyone claiming traditional IRA deductions, if this box is checked, then it limits your the amount that you can put into your IRA and the amount that you can deduct for tax purposes. If your local jurisdiction takes income taxes out, it would be here too. But San Francisco doesn't require you to pay income taxes. All right. We talked about tax documents, W-2s. Sorry, I didn't go into 1099, but there's so many of them. If you have any questions, we can maybe answer them in the questions. But let's go to filing status next. You know, we talked about it a little bit. You know, it's between single or married, but there's also a lot of rules between what filing status you can take. So let's start with single. What single means is you're not married at the end of the year and you don't qualify for the other statuses. Simple, right? If you're not married, this is what you are. Other option is if you're married, right? If you're married, you can either choose to file together with your spouse or you can choose to file separately. And you can actually use these married filing statuses if your spouse died during the year. So the year that your spouse died, you can still use the MFJ for short and MFS filing status. But after that, you'd have to use a different filing status. The next filing status is head of household. And this one's a little trickier because there's a lot of components that make up what it means to be a head of household. So the conditions are just at a high level. You can't be married at the end of the year. You have to have paid more than half the cost of keeping up a home for the year. You have a qualified dependent living with you in the home for more than half the year. Exceptions include if your dependent is a parent and they don't have to live with you. That's okay. Another thing is if your dependents are off to school, like when we went to college or some sort of institution where you can't be home because you're in dormitories or whatever, that's okay as well. So you would still qualify for head of household if that were the case. Lastly, there's qualifying widower. So this is, as the name implies, if your spouse died. Remember, for the first year, you can use married status, but after that, you can use qualifying widower for the next tax year. So for example, if your spouse died in 2021, that first year you can use MFJ, MFS. But then for 2022 and 2023, you can use qualified widower. And what this all means is for filing status is that depending what your filing status is, you have different amounts of deductions you qualify for, and your range for your tax bracket is wider. So that's why it's beneficial to go down this list, right? Single is the least beneficial. Next comes married, and next comes head of household, and so on and so forth. Okay, questions? Sorry, that was a quick cut, but let's see. Does 1099-G also include COVID payments from the government? So your stimulus payments are actually not taxable. It's considered, in a sense, a refund. It's not considered income at all, so it's not reportable. What happens if your employer fails to provide you with a W-2 at the end of the year? You can take it up with, in California, what is it called? The EDD. You can take it up to EDD, and they will help you figure out what to do. But by law, they have to give it to you at the end of the year.
That's something you need, right? Like you can't go without it.
Yes, actually. If you paper file your taxes, you have to actually attach the W-2 form. So they have to give it to you. They don't have to give it to you at the end of the year, like in 2021. They don't have to give it to you by December specifically because they need time to calculate it, but they should have it to you by February. But because of the pandemic, I don't know if that's changed, but typically they're supposed to give it to you by February. What is the difference between an IRA, a Roth IRA, and a 401k? That's a really, really good question. And we'll probably do another presentation about this. Our first ever spread, we talked about this before, but this is definitely another topic. But at a high level, IRAs are contributions towards retirement, right? And there's different types of IRAs. If you just say IRA, that's a traditional IRA, meaning that you put in money that's been taxed now, and when you retire and take that money out, you got to pay taxes on it. But a Roth IRA, I'm confused. If traditional IRA, you put in money that has not been taxed yet, so it's before taxes, and then you would get a deduction on your tax return for it because technically you're using money that they already took tax out of, so that's why you get a credit on your tax return. And then when you retire, you'd have to pay taxes on that income. But a Roth IRA is you pay money that you're taxed on now, so you won't get a deduction on your tax return. But when you retire, you get that money tax-free. And everything that in that investment, if it increased, right, all that earnings, they won't be taxed either. And a 401k is basically the same thing as IRA and Roth IRA, but it's through your employer. IRAs you have to purchase yourself, but a 401k is through your employer. And typically those are pre-tax. But they may offer a Roth version. And whenever they say Roth, it just means you pay taxes on it now, but you don't have to pay taxes on it when you retire.
Related to that, Anna? For like box 13 on the W-2,
Yes.
That's like if your employer like contributes to a 401k. What was the relationship again between that box and whether or not you have a Roth or a traditional IRA?
So that might be better saved for the presentation, but I'll just answer it for you at a high level. So when you have an employer-sponsored retirement plan at work, so it's called a covered employer plan, retirement plan, your AGI gets lowered. Does that make sense? Like, sorry, when you're looking at the amount that you can contribute to an IRA and the amount of credit that you can get to reduce your taxable income is actually your AGI, reduce your AGI. They look at how much you make, right? They look at your AGI and there's a range. If you exceed the range, then you can't put anything towards your IRA and your deduction either gets lowered or you don't get it at all. So when you're covered through a sponsored employer retirement plan, that AGI range gets even lowered. So you have to make even less money in order to qualify for the IRA contribution and credit. So if you're covered by an employer retirement plan at work, then chances of you being to get an IRA deduction are lower.
Generally speaking, what's the kind of cutoff for like AGI and?
I'm sorry, I don't know the answer, but
200K or something.
Oh, sorry, I'm typing with one hand. I personally, for anybody who likes Googling stuff, I like looking at NerdWallet. Yeah, traditional IRA, right? Like this is Maggie, your modified AGI. So basically it's your AGI, but you have to add back certain things because they don't consider that as deductible or you have to consider that income. So if you're single and see, you're covered by retirement plan at work. If you in 2021 make less than 66K, you get the full deduction. But if you make more than 76K, you don't get anything. But between 76 and 66, you get partial.
Okay.
But yeah, but it's different if you weren't covered at work. They don't have it here, but yeah, if you weren't covered by a retirement plan at work, these amounts, these ranges here would be bigger. So it wouldn't be 66, it would be something bigger. Okay, if you're a contractor and your client is from another state, New York, do you pay the New York sales tax on the W-2? If you're a contractor, you wouldn't be paid through a W-2. But if you mean that you have an employer and you're being sent, your client is in New York, you don't have to pay any sales tax. I'm sorry, this question it's a little bit confusing, but if you're a contractor and your client is from another state, do you pay the New York sales tax on the W-2? I think they mean income tax, but do you pay on the W-2?
Yeah, I wrote that question. Sorry, income tax.
Okay. If you're a contractor and your client is from another state, what do you mean by client?
Like if you're a contractor and someone from New York hires you to do a job, do you pay the New York tax rate?
Yeah.
Or
do you owe New York taxes, or is it just where you're working from?
Yeah.
Okay, so sorry, you're not employed through like an employer. You're a contractor.
Yeah.
It depends on the work you do. So there's this thing called Nexus, which is a fancy name for connection. So there's different state laws saying what determines as a connection. So if you physically did the work in New York, you'd have connection to New York. So you would have to pay New York sales income tax. But let's say like you're doing
Online work.
Like online work. You'd have to look up the specific state nexus laws, but I would consider that as not considering as having a nexus because you're not physically there, but you're providing the service remotely, but they're paying from New York. I don't know if that'd be considered nexus. Is that enough of a connection? But you'd have to look that up. But like I just gave you an example. If you physically did the work in New York, then yes, you would have to pay New York sales tax.
Okay, got it. Thank you.
So you could theoretically owe New York a bunch of taxes without knowing it, right?
Yes, you could. Not funny.
Well, how would you know though if you didn't know? You know what I mean?
You'd get you probably, if you thought of taxes, you'd probably get like a mail from the state of New York saying you owe taxes. Where do I find credits claimed on my 1040? We'll actually go through that, but it's on your second page of your 1040. That's where all the credits are. Thoughts on free tax filing software like Credit Karma. Do they do enough? Could they do more? We'll actually talk about that later, but personally, I'm not a fan of Credit Karma, but that's just my personal opinion. But we'll talk about that later. Okay, a lot of questions. Good questions, too. Okay, let's go on. So we talked about filing status. Now let's talk about our favorite, right? How to bring down the amount of taxes we owe. So remember, there's two really deductions, right? Three, actually, if you want to consider that one. The first one is an adjustment to income. So that brings down your AGI. And remember how important that is, because AGI is used to determine a bunch of things. So we want to lower our AGI as much as possible. And the only way to do that is through adjustments to income. And these are very common adjustments here, including the IRA deduction. As I mentioned, traditional IRAs, they let you get a deduction because you're technically supposed to be paying pre-tax amounts to get taxed on it when you retire. And the way they give you pre-taxed amount is by giving you this credit through your tax returns, because the money that you have on hand, it's already taxed through your employer, right? They already took the money out through your paycheck. So they give you the credit to make that amount you're putting to your IRA no longer taxed. So it's considered pre-tax. But it's subject to modified AGI limitations. And as I said, modified AGI is your AGI adding back a bunch of things, such as tax-exempt interest income. You'd have to add it back. Certain deductions are added back, like rental losses, passive income. So if you make rental income, you'd have to consider it as or you wouldn't consider it. Sorry, it's like a bunch of things. So if this is important to you, you need to look it up. But generally, most of us, AGI would equal to modified AGI. But look it up if it matters to you. Second is student loan interest deduction, and this is subject to MAGI limitations. And what the student loan interest deduction is, if you have any interest on student loans, you can deduct it as an adjustment to income. There's also tuition and fee deductions. Remember, this is where your Form 1098-T comes in handy. If you pay tuition, a certain portion of it you can adjust your income with. Number 4, educator expenses. I know we have a lot of educators in our audience. So if you made any expenses for the benefit of your students or for your classroom or whatever, you can adjust your income for up to $250 without MAGI limitations. And actually new in 2020 and 2021, if you made a qualified charitable contribution to these qualified organizations, you can actually deduct up to $300 if you're a single filer, or $600 if you're married filer jointly. So by deduction, I mean above the line. So these bring down your AGI. And normally when you donate to charity, this would be considered below the line. But in 2020 and 2021, you can actually bring down your AGI with it. So something to consider if tax planning. Let's talk about below the line. Below the line brings down your taxable income. And the IRS lets you pick between 2 deductions. It's only one or the other and not both. The first one being standard deduction, and the second one, itemized deduction. So the standard deduction is the standard amount given to taxpayers based on your filing status. And I'll show you what the standard amounts are. Basically, they give this to everybody. You don't have to do anything special. You don't have to do extra bookkeeping or anything like that. But then second option is itemized deductions. And these are deductions where only a specific type of expense can be deducted. And there's a list of what's considered qualified expenses. And really, you should only use itemized deductions if it is greater than your standard deduction. So remember, you can pick both. I mean, you can pick one or the other, but not both. And deductions below the line are important because it lowers your taxable income, which lowers how much is actually subject to tax. Okay. So the reason why I said you really shouldn't take the itemized deduction unless it's bigger than your standard deduction is because standard deductions are huge. Beginning in 2017 or after Trump made his tax reform, the standard deduction went from like $6,000 to $12,550 in 2021. So it's near double and it's a huge amount. If your itemized deductions are greater than this, then yes, take the itemized deduction. But otherwise, I would think that most people would qualify for the standard deduction. So you can see here, if you're single, $12,550. If you're head of household, $18,800. Married, filing jointly is $25,100. Married filing separately is the same as single because you're married, but you're not filing together. So you're just one person. But notice that single and married is just double the single. So that's something to keep in mind as well. And if your dependents filing their own tax return, they get this. Now let's jump to itemized deductions. Itemized deductions are reported on Schedule A of your 1040. So there are a lot of subforms to Form 1040, but if you itemize your deductions, you have to fill out this extra subform called Schedule A. And the general expense groups that are allowed to be considered as part of your itemized deductions are these. The first one being medical and dental expenses. So it's limited to 7.5% of your AGI. Like this is where AGI comes in important, right? You want to lower your AGI as much as possible because it limits how much you can consider as your itemized deductions under medical and dental expenses. So if the lower the AGI, actually in this case, if the lower the AGI is not as beneficial, sorry, but AGI it's used for a lot of calculations just like this. So here, the medical and dental expenses. So anything medical and dental related, but not including insurance premiums, that's not counted. So if you have to pay out of pocket for any of these, keep the receipt. Other things are taxes paid, but it's only limited to $10,000. So if you paid a bunch of taxes, you only get $10,000 no matter what. But you can deduct state and local income taxes because remember, this is a federal tax return. You can deduct state and local taxes or sales tax. So one or the other, but not both. I would recommend state and local income taxes because it's easier to figure it out. If you decide to deduct sales taxes instead of income taxes, you'd have to keep like a whole shoebox receipt of all the things that you pay taxes on during the year. Is it bigger than your state and local income taxes? I don't know, but that's up to you to decide. Other things include real estate and personally property taxes. So this would include like property taxes if you own a home. Interest paid. This includes investment interest and mortgage interest. So fun fact, before the tax reform, you could deduct interest paid on the first $1 million of mortgage debt. But after tax reform, you can only deduct the first $750,000 of mortgage debt. So in San Francisco, where homes are like $1 million and up, after the tax reform, it really became not that beneficial for homeowners to take the itemized deductions because your property taxes get limited and your mortgage interest gets limited as well for itemized deductions. And next are charities. So charities, you can deduct, right? I mentioned that for itemized deductions, but they're subject to AGI limits and rules, but you can deduct $300 in 2020 and 2021, I checked, without needing to itemize. So that would bring down your AGI. And casualty and theft losses are also deductible under itemized deductions. So what are these? These are damages to your personal property that are either declared as a state or federal emergency. So remember the wildfires up north in California? All the homes lost and personal property lost, those will all be able to be deducted under itemized deductions minus any amount that your insurance paid out. Cool. Now let's talk about tax credits. another way to bring down how much the tax you owe. There are a lot of tax credits out there, but this brings down your tax liability. And there are non-refundable and refundable credits. But some common tax credits are the earned income tax credit, and this is for low to moderate income workers and families. The government wants to give them a tax break. And what the basic requirements are you have to make earned income. It has to be less than $3,650 in investment income. So you have to earn money, meaning you have to work at least $1 in order to qualify for this credit and have less than $3,650 in investment income. You have to be at least 25 years old, and you cannot be claimed as a dependent. And your main home in the U.S. you have to live in there for at least 50% of the year, so half the year at least. There are also a lot of dependent and child credits. I'm not going to go over them because there are like at least 2, and I think most of us might not have a child and might not have a dependent. So if you think you qualify for these, please look them up. Another credit, the Savers credit, is not refundable. So you're not going to get extra for it. And this one's pretty cool, actually. I learned about this while doing research for this presentation. If you contribute to an IRA or employer retirement plan, you can actually deduct a certain portion. They give you a little credit, like around $1,000, to deduct as a credit on your tax return. But it's really for low income filers because they really want to encourage low income filers to invest for their retirement. So you have to have less than $33,000 in AGI in order to qualify for this credit. If anyone is still in school, there's 2 education credits to look at here. There is the American Opportunity Credit, which is partially refundable, and they give you $2,000 for tuition, books, and course materials. But it has to be towards a bachelor's or associate's degree, so no graduate school. You have to be a half-time student for at least 1 semester, and the amount that you spent cannot be for dorms and health insurance. So that is up to $2,500 for that credit. The other credit is the lifetime learning credit. So this one is eligible for graduate school or any other trade school, actually. So you can deduct 20% of up to $10,000 in qualified education expenses. So it has to be both of these credits have to be for an eligible institution, meaning that for anyone filing FAFSA, they have to have a school code. So I don't know if Duolingo qualifies for this, but if you go to a trade school or a college, it could be community college or state or private university, if it has a school code, a federal school code, then these credits can apply. And lastly, there is the 2020 Recovery Rebate Credit, and this is new. And this is for anyone who missed the first and second stimulus payments only. So if you didn't get the first stimulus payment, which is the $1,200, or the second one for $600, then you should file for this tax credit. And it's refundable, right? Because you didn't get it. And the only way actually to get these missed stimulus payments is by filing a tax return and filing for the tax credit. All right, let's do a little question. Do I take the standard deduction versus itemized deductions? This is a little tricky since I only talked about it briefly, but take a stab at it. I'll read out the questions. Only taxpayers who make over $20,000 itemize their deduction, or you can take deduction with the highest amount, or single filers always take the standard deduction, or taxpayers can take both deductions if the total deductions together are less than my total income. So the question again is, when do I pick the standard deduction over an itemized deduction, or vice versa, right? We have 4 replies. Let's see if we can get to 9. And pretty sure at this point, this is what I do too for these kind of presentations. I just pick the one that everyone's picking. Or maybe everyone's super smart and I did a good job presenting this. Let's try to get one more response. Okay, cool. Yeah, you guys are right. You pick the deduction with the highest amount. So let's go through the wrong answers. Only taxpayers who make over 20K can itemize deductions. That's not true. Anyone can itemize their deductions. Single filers always take the standard deduction. That's not true. You pick whichever one is the highest. Taxpayers can take both if total deductions together are less than my total income. That's false because you cannot take both. You can only pick one or the other. Okay, good job, guys. Okay, let's look at questions now. What are the tax benefits to filing as a married couple, if any? So for the standard deduction, sorry, I was blanking out. For the standard deduction, remember, that's like double if you are married. Also, we're going to talk about tax brackets, but I think the most important part about being married is that your tax bracket gets wider. So you can fit more income into a bracket, and effectively it lowers your income, taxable income. And effectively that lowers your tax liability. And also there's some credits that are only available if you're married. So keep that in mind. And when you're married, you can share each other's income. So if one couple, if one partner makes less than the other, it helps lower the taxes for the person making a lot of money. So being married would be beneficial there. I'm sorry if that's not a good answer, but basically you would get lower taxes and you may qualify for credits that you otherwise wouldn't qualify for. And it makes filing taxes easier together. Can you go into more detail on the implications of the 2017 tax reforms on mortgage interest deduction, $1 million versus $750K? Yeah, so before, if you bought a house for $1 million, the mortgage interest you paid for that $1 million can be fully deducted. So if your mortgage is worth $1 million because your house was $1 million, any interest you paid on those mortgage payments, they're all deductible for itemized deductions. But now, after 2017, if you have $1 million home, only the first $750,000 of debt, interest on that debt, is deducted. So that $250 of debt, that interest is not deductible. Hope that makes sense.
Is this for like each property, or is it like a total?
Total.
Per year, you can only claim that much in mortgage interest. Okay. Yeah,
and if you have a home, your mortgage lender should be giving you I forget what it's called, but it's an end of the year form as well that tells you how much interest you paid and how much on principal and whatever for tax purposes. So you can use that as a reference. What was the Savers credit again? So the Savers credit is a credit if you contribute to an IRA or an employer retirement plan and your AGI is less than $33,000, you would get a credit on your tax return for that. And I think it's around $1,000. So if you have AGI less than $33,000 and you contribute to retirement, you can get around $1,000 credit. Can you link the list of possible tax credits after the presentation? Yes, we have that ready. Cool. So we figured out our tax credits. Now let's jump into the rough stuff of calculating your taxes and completing your tax reforms. So how do you calculate your taxes? It's a common misconception that income taxes are a standard rate that goes up when your income goes up, right? A lot of people say that, oh, I don't want to make so much because I'm going to have to pay more taxes. And that's true, but it's not as much as you may think because it's not like sales tax. We don't apply one rate to your entire taxable income. It's in brackets. And what brackets are, it's ranges of taxable income that are each taxed at different rates. And we'll go through an example, but there's two ways to calculate your taxes. You can do the easy way, which are tax tables, and I'll show you what they are. But there's the more calculative way, which is using the tax bracket rates. And you can do this at home, and this is what they tell you to do when you're filing your estimated taxes, because the tax tables may not be available when you do your estimated taxes. So let's show you the tax bracket rates. This chart, if you're looking at it and you're going, what is going on? No worries, we're going to break this down. But really, remember I told you how brackets are ranges of taxable income. So under single individuals, we'll focus on that now. So this is for single filers. They're breaking up your income into sections, right? So the first section is 0 to 9,950. The next section is 9951 to 4525. And all these sections are taxed at different rates. And that's exactly what I said, right? Each bracket is a different tax rate. So meaning each range of taxable income, each chunk of your taxable income is taxed at a different rate. So it's not like this. So if you look at this chart, for a single filer with $75,000 of taxable income, you might be like, okay, well, my income is $75,000. So I'm here in 22%, right? Because that's where my taxable income is. So I just multiply my 75,000 by 22%, and I have to pay $16,500 in tax, right? No, that's wrong. That is not how bracketed taxes work. Instead, think of your $75,000 as this bar here. And this bar is broken up into different sections that are taxed at different rates. Your first chunk of the bar is only worth $99.50, and that's taxed at 10%. So that's $995. $100, yeah, dollars. And then your next chunk of your $75,000, that's taxed at 22%. Which is $3,668.76. So the IRS doesn't really care about cents, but for, this computation purposes, I'll include them. And your last chunk is taxed at 22%. So of your 75%, each bracket is a chunk of your income and is taxed at a different percent. If you add this all up, it's only $12,248.26 versus the $16,500. So that's like $4,000 difference, so it's really important that you understand what bracketed taxes are, right? So yes, it's true, the more you make, the more taxes you have to pay. But look here, let's say here in 40,000 in the second tax bracket for 12%, 40,525 is the ending portion of that bracket. For the next dollar I make, if I make this much money, $40,526, that $1, only that $1 is taxed at 22%. My first section is taxed at 10%, and the next section is taxed at 12%, but only that extra dollar in the 22% is taxed at 22%, not the entire amount. So yes, you're paying more taxes, but it's not as much as you think. And where your taxable income lands, which bracket it lands on, that is called your marginal tax rate. So if anyone asks you what your marginal tax rate is, it's where your taxable income lands in. But if we divide our total tax liability by taxable income, we get our effective tax rate. And that's how much you multiply your tax liability by to get your actual taxes up until you leave this bracket. So because $75,000 is still within this 22% tax bracket, we can use 16% up until you pass $86,375. So you can multiply your taxable income by the 16% until your taxable income goes into the next bracket. So we multiply our tax liability by effective tax rate to get, we multiply taxable income by effective tax rate to get our tax liability. And where your taxable income lands is your marginal tax rate. And for people, IRS knows math is hard. So they give you this thing called a tax table. And what this essentially does is it's a cheat sheet, really, is what it is. You can look up your taxable income and they will tell you how much tax that is. So let's go to $75,000 in taxable income. Where is it? Oh, it doesn't even go that high. Oops. Okay, well, let's look at a random example. Oh, I'm in the EIC, my bad. Oh, let's go here. Okay, let's go to 75,000. $75,000 right here. Okay, so how do you read this table? Let me make it bigger. So you look at this chart. They ask you what your taxable income is, which is line 5 of your tax return. If it's at least this amount, but less than that amount, depending on your filing status, this will be your tax. So let's check our math. My taxable income, or that's what the example was $75,000 in taxable income. It was a single filer, so their taxes are $12,296. Was it $12,296? $12,248, give or take. So the tax bracket rate amount might be slightly different than the tax table. And the IRS actually lets you pick between where you got your taxes from, either the tax table or the calculated tax. I don't know if this is wrong either, but I'm sorry. I'm pretty sure I'm right, but it's pretty close. So you can use either way to calculate it, but this way is simpler and it might be higher on by a couple dollars on the tax table. And there's a California version of this as well. So governments know it's not easy doing taxes. So they give these little cheat sheets, right? So if you're 1 or 3, you're single or filing separately, and 2 or 5 is if you're a qualifying widower or you're married filing jointly. So it's the same thing. You just look at your taxable income for California and then determine whatever taxes it is. Fun. Okay, and basically what all these steps are steps that the tax return form asks you to list out. And the next thing you have to do is just pay your taxes and wait for the refund, or wait for a refund after you file your tax forms. So we're going to jump into tax forms next, but before that, let's look at any Q&As. Nothing. I don't have any questions. I don't think I have any questions. Yep, I don't have any questions. Cool. Let's go on to the actual form.